When I started trading options, there were so many different tutorials, so many different ways of explaining, and so many terms that I just didn't know where to start. I just combed through hours of content until I could grasp the basic concept. In this video, I want to give you all the tools that you need so that you can start trading options right away. Welcome to Modern Options. I'm here to teach you how to trade stock options and help give yourself a better quality of life. Start off with just what are options. So options give you the power to control 100 shares of stock by either buying or selling that 100 shares of stock at a certain price by a certain expiration date. And everything that you see with all options prices are all going to be multiplied by 100. So like, for example, in the options chain, you might see something say 10 cents. Really, that's meaning $10 because you're multiplying it by 100. Options consist of calls and they consist of puts. Calls mean that you have a bullish outlook on the underlying and you think that the stock will go up, and puts have a bearish outlook on the underlying and you think that the stock will go down. So for this tutorial today, I'm going to be using the Robinhood brokerage platform. It's probably the easiest platform to use, least barrier entry, and just the best interface for you to start out on, in my opinion. So you're obviously going to need to open up a brokerage account first. You can do this with Robinhood. You can do it with TD Ameritrade. You can do it with E-Trade. There's a whole bunch of them out there. So once you open up an account, you'll be able to buy and sell stock, and then I believe crypto as well right off the bat. But you're not going to be able to trade options right away. So if you don't see this trade spy options thing, you're going to have to first go over to your account and go to settings. Once you're inside there and you scroll down to settings, there should be an option that says option trading. And when you first go to it, it's going to have to say apply for options. I believe to first get approved for it, you have to trade a few stocks. Once you do that and get approved, you're ready to buy and sell calls. And you're not going to be approved for level 3 right away as well. You're going to have to buy and sell a few calls or puts in order to get approved for level 3, which allows you to do spreads and some advanced option strategies, which we'll go over in some later videos. So going back, we'll go over the options chain and go over some basics and understanding of options. Once you click on Spy Options, it's going to take you over to what is called the options chain. So before you buy your first option, there's 4 key things that you're going to need to know. The option type, the expiration date, the strike price, and the premium. In addition to these 4 topics, there are 2 things that as a beginning options trader, I really wish I knew. Stick around to find out. Now, there are a few ways that you are able to actually trade options. It took a while to grasp. So if you don't grasp it right away, don't worry. So you can buy to open a call. You can buy to open a put. But you can also sell to open a put and sell to open a call. If it sounds confusing, you're probably right. So what buying a call means is that you have the right, but not the obligation, to buy 100 shares by the expiration date at the strike price that you choose. You'll make money off of buying calls if the equity that you chose rises in value. Now, when you buy to open a put, that means that you have the right, but not the obligation, to sell 100 shares of the equity you chose by the expiration date at the strike price that you chose. You'll make money off of buying puts if the equity that you chose goes down in value. So if you sell to open a call, that is known as a covered call, and you get to keep 100 shares of the equity that you currently have, but also make additional income by receiving that premium upon selling the options contract that you choose. The difference from buying a call is you now do have the obligation to sell 100 shares of your equity. You need to already have 100 shares of this equity before you make this trade. Your shares can be called away at any time before the expiration date should the option buyer choose to exercise their option. Or if at expiration your call is in the money, it will automatically be exercised and your shares will be called away. The ideal scenario is the option expires out of the money and you keep the full premium that you received as well as keeping your long stock. But in case you do get called away, make sure you're selling them at a share price that you're comfortable letting them go at. If you sell to open a put, that's known as a cash secured put. You do not have to own any shares of the stock, but you do have the obligation to buy 100 shares of that equity at the strike price you choose if it ends up in the money. So you will need to put that money up as collateral right from the start. The difference from buying a put is you do have the obligation to buy these 100 shares if the option buyer chooses to exercise it, or if your put falls in the money at expiration. So if there's a stock that you want to own, but you want to wait for a pullback or wait for a discount to buy in, you can do so while also receiving premium and getting paid to enter into a cheaper position. Traders also use this strategy and hope that the option will expire out of the money and keep all the premium received and also get the money that they put up as collateral back. So the expiration date is the day that your contract becomes void, and you can pick a daily, a weekly, a monthly, or a yearly contract. Generally, the farther out you go, the safer those plays are going to be. So when you're just getting started, I'd recommend at least doing something that's 30 days out or at least a month out. So you want to go farther out because it gives you more of a chance to be right. All options decay in value and eventually to zero if it expires out of the money. So if the stock goes against you and you picked a weekly contract, there's a good chance that you might lose all of the money that you bought the option with. So now let's talk about the strike price, and this is the price at which you can buy or sell the stock at by expiration or if you end up getting exercised. There's 3 different categories of strike prices and how to define them: in the money, at the money, and out of the money. If your equity is in the money, then that means it has a favorable value and would actually have worth at expiration. For example, if you bought a 380 call option on SPY expiring in February, for the contract to have value, it needs to be traded above 380. Let's say SPY ends up being worth 390 by February 19th. Well, then clearly anyone would want to have an equity $10 cheaper than the current share price. So that means that strike is in the money by $10 and it has value. The same concept applies for puts, except it's reversed. If you bought a 380 put for February 19th and SPY ended up being 370 by February 19th, clearly it would be a better deal to sell your shares at a 380 price than at a 370 price. So again, that contract would be $10 in the money and would have value. At the money describes the strike prices that are directly where the equity is currently trading at. It's usually the first strike above or below, and that is what's considered at the money. If your equity is out of the money, then it does not have favorable value and will be worthless at expiration. So if you bought that same 380 call option and the SPY traded at 375 by February 19th, no one would want to pay $5 more per share for a stock that they can get cheaper instantly. Therefore, that options contract would expire worthless and have no value. Again, this is reversed for puts, so if you bought the 380 put option and SPY ended up trading anywhere above 380, it would expire worthless and have no value. And that brings us to the premium. There are 2 values that make up the premium, and that is intrinsic and extrinsic value. Intrinsic value is pretty easy to calculate, and equity only has intrinsic value if it's in the money. You subtract what the stock is currently trading at by the strike price that you chose, and that's how much intrinsic value the contract has. The rest of that value that makes up the premium is called extrinsic value or time value. Extrinsic value is measured by how much time you have left on the contract and the volatility of the equity. So for example, this 380 call option on SPY expiring February 19th has $2.67 of intrinsic value and $6.37 of extrinsic value. Every day that goes by, the option contracts lose value, and that is taken away from the extrinsic value of the contract. The closer you get to expiration, the faster the decay starts to pick up. The first big curve where it starts to pick up is about 30 to 45 days out, and then the next one is during that final week of expiration. So if the expiration is getting close and your contract is at risk of becoming out of the money, it's probably best to just lock in your profits or even a loss so that way you're able to still continue to trade. Now let's go over all the fields that are within each options contract. So we just went over the strike price. The break-even price shows where the equity needs to be trading by expiration in order for you to break even on the trade. Since you paid $9.04 for the contract and bought a $380 call contract, SPY would have to trade anywhere above $389.04 for you to actually make money on the trade. Then right next to it is just the percentage value. The change shows the percentage and the dollar value that the contract moved from yesterday's close. The bid is showing what buyers are currently willing to pay for that contract, and the ask is showing what sellers are currently willing to sell that contract for. And the mark is also known as the bid-ask spread, and that's just the price that's in between both the bid and the ask. The previous close shows what the options contract was at the closing bell yesterday. The high is for the current day, how high the options contract was at one point, and same for the low. The volume shows that how many contracts were traded within that current trading day, and open interest represents how many contracts are currently open on that. So you're going to generally want to find contracts that have more open interest, which means it's going to be much more liquid for you to be able to get in and out of your trade if more people are actually trading that asset. Implied volatility is a metric that captures the market's view of the likelihood of changes within a given equity's price. The higher the IV, the more chance that the equity's price action will be very sporadic and swing up or down large percentiles. That brings us now to the Greeks. Delta represents the value the option will move for every $1 price increase in the stock. So if SPY moves up $1, then the price of this contract would increase by 57 cents to $9.61. Gamma represents how much the delta will increase for every $1 move in the stock. So for the first dollar move, this contract would increase by 57 cents. Then the next dollar move would increase by 59 cents. You just add the delta and gamma together and are able to tell how much the contract will move in the first $2, all else being equal. Theta represents how much the options contract will decay by every day. So if I hold this contract overnight, it will automatically decay by 13 cents no matter if SPY increases, stays flat, or decreases. Always be aware of the theta value before entering a position that you will hold overnight. Vega represents how much the options contract will move for every 1% increase in IV. And Rho represents how much the options contract will move for every 1% increase in interest. The main three that you're going to want to focus on arguably are the delta, gamma, and theta, as these will have the most influence on your options contract. All right, so that's just about everything that you need to know to have a basic understanding of options. Now I'm going to tell you the two things that I wish I knew when I first started trading options. For number one, you do not have to hold any options position all the way until expiration. If your options contract gains value and you would like to lock in the profits, you can do so at any time. Just make sure that you're aware of how many day trades you do if you enter and exit the position on the same day. If you do 4 day trades within 5 trading days and have an account that's valued under $25,000, your account will be restricted as a pattern day trader and you won't be able to open any new positions for 90 days. Number 2, the break-even price on the contract is only the break-even price if you hold all the way to the very closing bell at expiration. I was confused when my first options play said that I already made money, but I was nowhere near the break-even price yet. That's because the contract rose in value and still had tons of extrinsic value left. You can definitely close out any trade that you are positive on before you hit that break-even price and walk away with profit. If you've come this far in the video, thanks for sticking around and supporting the channel. If there's anything in the video that you are confused about or want to know more of, be sure to comment below and I'll either answer you in the comments or I can make a whole video dedicated to your question. Stay tuned for my upcoming videos where I'm going to go more into depth on advanced option strategies and discuss risk management. Make sure you subscribe so you don't miss out.